Hello fellow option traders, this is Jeff, and this is the second video in the Credit Spread System version 2.0 series. And this video is going to be all about the system rules and how to identify them on the charts once you have your charts set up. Alright, well, let's just get started here. I'm going to stick with the Amazon example, which is the same example that I have in the rules. And here is the actual document with the rules in it for the Option Guru Credit Spread System 2.0 from last Sunday. This is, in case you're wondering, today is Sunday, January 19th, 2014. But that's irrelevant at this point. Doesn't really matter. The system is timeless. It does not depend on what kind of market you're in or anything. It can be a bear market, it can be a bull market, it could even be a consolidating market, and there's always opportunities out there. Okay, so here's the rules. Alright, I'll start with our Amazon example. First thing I want to do is I want to break this chart away and make it a separate window. So I just right click this icon up here and I'll make it a separate window. And drag it over here so we can see it. And I may want to, how about if we increase the zoom level a little bit? Alright, so here's the example in the book. And I think, let's see here, get that chart up here along with it. Okay, now we have them both here. Let me drag this down so we're not seeing that other stuff in the background there. Okay. Alright, so let's get started. In this example, number one, the 50 MA is moving up, and here it is right here. This is the 50 MA. It's moving up. Let's pretend that we're back here on this particular day. And here is actually the day before. Now we're getting a setup here. We have a %K red-green line, or the fast line, on the stochastic. Must be an uninterrupted red line from greater than 80 to less than 20. So here we are, greater than 80, and it's coming down, and it is less than 20. This little box up here is going to tell you what the value is here, and it's 19.2298. Now, it's not necessary to make that a hard and fast rule. I have taken trades when it gets below 30, if it's a very strong moving stock and it's not going to maybe not give me another opportunity to get in and I want to get in on it, I might take a little bit of a chance there. But normally I would not. And that's not what the rules say. But it qualifies here. We have a solid red line down on the stochastic. Alright, we move to the next day, and that's this day here, and we get a hook up. So now it says the second part of it is in the current time period, %K has hooked up from red to green from below the 20 line. So here we are, we have hooked up. Actually, this line ends right where this dashed white line is. Actually ends right here, so it has hooked up. Alright, the condition has been met. The second condition is the MACD must be green. So if the MACD is red and the stochastic is green, then you wait one more day. If the condition is not met and it's the end of the day, enter. If the condition is met, sorry about that, and it's the end of the day, then enter. If the condition is not met, wait one more time period. If the condition is not met in the third time period, then pass on the trade. But here we have met it. It's at the end of the day, it's like 3:30 in the afternoon. Alright, so next one. Time of day. If both conditions are met and it's within a half hour before the market closes, then it's a good time to enter. So theoretically, you would enter somewhere up here on this candle at 368 or something like that. So you might be shooting for like a 370, a 370 strike, but we'll get to that in a minute. So if it's a good time to enter. Otherwise, wait until at least 30 minutes after the market opens the next day. If the condition still must be met and the price should be above the previous close. Well, as it turns out, that did happen. The conditions were met. It is above the previous close. So you could enter this the next day. Well, let's get back here. We're still back on today. All right, so your short strike, you would use an at the money or about a 50 delta bull put in this particular trade. You'll be looking for a credit of about 50% of your strike spread. For example, on a $5 spread, a credit of $2 to $2.50, and on a $3 spread, a credit of $1.10 to $1.50. The reason why we do that is because, for instance, on a $5 spread, if you get a $2.50 credit, you're only risking $2.50. So that's a 1-to-1 trade. Your risk is the same as your reward, and that's a good thing because most of the time these work out. And if you're looking for, 55 or 60% success rate, then you'll make money. If you're risking $500 to make $1 and you're running a 60 or 70% success rate, you're going to be losing money. So that's why we go with an at-the-money trade. All right, so for a $5 spread, for a long strike, it would be the next strike. For a $2.50 spread, which is rare, use the next strike for your long strike. And for dollar spreads, don't go further than $3 from your short strike for your long one. You can go more than one strike, but if you go more than 3 strikes, you'll rapidly begin to lose reward and increase your risk. The most juice or premium versus risk is using one strike most of the time. I very rarely see it any different than that. All right, so let's take a look at that. And I'll tell you what I'm talking about there. You may already know. We'll go to the Analyze page, and what's the date on this? This is 11/21. So we will jump over here to Think Back, and we'll go to 11/21. Here we go, 11/21. Okay, so is that right? Yeah, 11/21. Okay. We would be using the next week's strike. So we'll open up this chain, and this is based on closing prices. So we would be looking at November 5 for our strike, and we'll be looking at around a 50. So like I mentioned, it would be 370 for this particular trade. So if we pick that, we have a delta of 53 here, and we say we want to sell a vertical. And here it is in November 5, and here we get $2.29 credit. So our risk is $3.61. $3.71. Yeah. No, that's at $2.71. So our reward's $2.29 and our risk is $2.71. So that's almost a 1-to-1 risk reward. So if we would have bought that or sold that particular spread, we would have collected $2.29. And make a note of that. Just for fun. Okay, so Let's get our rules back up here. Okay, so we picked the next strike for the $5 spread. Lately, some of the more liquid underlines, such as I know Apple and Google, a couple days before expiration, they'll come up with these $2. They're normally $5 spreads, and a couple days before expiration, they'll come up with a $2.50 spread. Which is, if you want to take a short-term trade in that, you can. But let's talk about what expiration you would pick. And the expiration is kind of up to you. I noticed, though, that a lot of these don't last longer than maybe 2 to 3 days, maybe 4 business days. So I would hesitate and be careful about holding over a weekend if you get in like on a Wednesday or a Thursday, because it may already have run its course. But a little bit of experience will help in that, and I greatly favor early exits. Like if you say, when I have a 50% gain on my trade, if you're risking, or if you're collecting $2.25 and you have made $1.12 or so on it, it's okay to get out. I mean, you can take your money off the table and you won't lose it then. But let's talk about expiration. In the rules, it states if it's Monday or Tuesday, use the next Friday expiration. Wednesday is a judgment call. Use Friday expiration if you only want to capture less than 100% of the profit. Or if the stochastics wave green portion is historically only lasts 2 to 3 days. So if we're talking about that, the stochastic 1 day, 2 days, 3 days, 4 days, 5 days on this one. And so that's pretty typical. Sometimes it might be 3 days, sometimes it might be 2 days. I mean, if it's shooting up really fast, it might only be 2 days. If it's Thursday or Friday, use the following Friday expiration. Always try to keep a minimum of 2 days away from expiration. So Thursday is only 1 day away from expiration. So if you use that, the coming Friday's expiration, Wednesday is 2 days. All right, and a note here about weekends. Be wary of weekends. If you have any doubts about the underlying's continued move in your direction, then exit near the close on Friday. Options have the weekendy cape built into them later on Friday, and it may not be worth it to hold until next week's open. Plus, there's a lot of risk. A lot of things can happen over the weekend. All right, now we're talking about exit here, but let's just talk about let's look at the stochastic and MACD rule here. First we'll talk about price. And like I mentioned before, if you decide that a 50% profit loss level is your goal, or a 75-50 profit loss, for instance, you'll exit if you are up 75%, or you will exit if you have a 50% loss. If you decide that, then keep to that decision and don't let greed enter your thought process. In other words, if it's moving up really well and you have like 80% of your profit, and you go, well, I'm going to wait, and it's at the end of the day, and you're saying, well, I'm going to wait until tomorrow, and then tomorrow it gaps down at the open, in the case of a bull put, then you will be kicking yourself. And that is where the greed comes in. If you decide you're going to get out at 75%, get out at 75%. On the other hand, another method that you can use is by watching the stochastic and the MACD. And this says, remain in the trade until both the stochastic and the MACD turn red. Again, you must wait until near the close of the candle for that day or that time period. If you're trading intraday or on a weekly chart, I wouldn't recommend doing the weekly thing, but I would highly recommend doing intraday for day trading. It works. This system works pretty well for day trading too. Okay, so let's take a look at what happened to Amazon. All right, the next day here we are green and green on the stochastic and the MACD. So we stay in. All right. On this particular day right here, the stochastic turns down, and this can flip around, especially one at this level here. I'm quite sure that this probably popped up green and then dropped down red and then went green and went red, back and forth during the day. That's why we like to wait until 3:30 in the afternoon to come and take a look and see what's happening. But the MACD is green, so you would stay in the trade per this rule. They must both turn red. All right, so the next day, as we can see here, stochastic went back to green and MACD continues to be green, so we would stay in the trade. And then the next day, they're all still green and we would still be in the trade. And then the next day, and I'm not sure, is this expiration? Yes, this would be expiration here because we got in on Thursday, and here's Friday, and then Monday, Tuesday, Wednesday. Must have been a holiday that week or something? That could be because it looks like there's only 4 days, trading days in that week. So it stayed green all the way into Friday. Oh, that was Thanksgiving. That's why there was no trade. So the market was closed that Thursday. So you could have stayed in until expiration and collected 100% of your profit in this particular case. So that in this example, this is how you use it. That's how it would work out. Now I have down here, this is the explanation of just what I just went through. And down here is for a bear call credit spread, or what I abbreviate to a BEC. And that would be if you have a moving average that is red. And I'll find one in a minute here, but the market is generally moving up, so it's been a very nice case for the market here for bear bull puts because of the uptrends. Most of the ones on my watch list are trending up. There's a few that are trending down. All right, so actually, Monday comes around and we have a solid red down, and it's solid red down, goes down to, watch this box here, goes down to 17.6668. Boy, it's splitting hairs. And then we get a hook up, but MACD is red. And we get another hook up, and MACD is green, so we could enter on this day, and let's say worst case, we go in maybe with a 390. Well, then the very next day, MAC turns red, but stochastic still green. MAC goes green, stochastic still red. I don't have a rule for this, but at this point I would be saying, you know what? I'm probably maybe not even at the money. We're probably still in the money here on this particular trade, and I would say, well, I'm getting out. And the nice thing about it, just because it's looking weak, it's not giving you the move that you would like to see, especially on the momentum down here, if it can't figure out which way it wants to go. It not in my hard and fast rules, but you would probably want to get out. So if you come along on this particular day here, and you would have still a couple of days before expiration, let's see, you would have gotten in on this day, that was Friday, so you would still have a couple days before expiration. You get out here, you probably would not have lost more than maybe $50 or $60 on this particular one. And that's just the way it works out. You know, it works really well. You don't lose a whole heck of a lot if you decide to get out. If you have a 50% loss here, then, you know, if you're looking at, you know, $100, $125 loss, probably max, then that's not all that bad, because you would have made $250 over here. So is there another one coming up here? This one doesn't quite get up there, so we have no entry here. And we have a violation here. We don't have a solid red line. It actually turned green for one day. So we have no entry there. But come along here, we have a nice solid red down. And on this day you could enter. And this would be Tuesday. I'm guessing this is Tuesday. And let's say worst case you enter at 400. I'm not sure, 400. Yeah, probably. Depending on what, I don't know what went on intraday on this candle. You maybe have gotten in at 395. Does they have, let's check to see if they have the 250 spread on Amazon. Close to expiration. Yes, they do. So they started with these 250 spreads, so it's quite possible you could have gotten in on this particular date at 397.50. And if you could, it would have been kind of scary a couple of these days here, but everything still remained green, and you stay in until expiration. If you're at 397.50, it closed at 399, so that would be 100% gain. In this case, it would have been maybe a $1.15 or something because of the 250 spread. So again, just to go back here and just look at this again, when we get closer to expiration and they're at $5 spreads, CBOE or whoever has decided that they want to make the 250 spreads, I think it just makes it more attractive for people, and they end up trading more contracts, which, you know, they're all about volume. That's how they make their money. So that's how they do it. I'm gonna take a look to see if I can find one that's in a downtrend for an example for you. All right, so for my bear call credit spread, set up entry and exit, here's a downtrending stock linked in. And we do have a solid green up. You can read these over here, but basically it's just the reverse of what we were doing before. So we're looking for a solid green up. This one didn't quite make it, but it made it to 74.5 almost, which is pretty close to 80 for me. So I started counting here. We need, okay, so the next day we're red down on the stochastic, but still green on the MACD. Then the next day, I'm lining things up down here. We're still green on the MACD. So on the third day here, MACD did turn red. It was kind of late in the game, but it got in anyway. And you can see that I got in at the 215 level. And sweated out a couple of days, but I ended up exiting on this day here where we had a double red down. And that would have been a good thing. It's showing strength in my direction. But after these couple of days here, I said, well, I'm going to take my money and run. So that was a successful trade. And then the next one here is we have a solid green up. And then we get a hook down. So that's a double red. Red on stochastic, red on MACD. I got in the next day. Oops. And when I got in in the morning, and this MACD was red at the time. But eventually it turned green. So I saw that. I saw the trade was not going very well. I believe I got out the next day and took a small loss. Either that or I got out that morning here with my 2 green ups. So yeah, it doesn't work 100% of the time, but it works so much. It works so many times that it amazes me, actually. And you have to follow the rules. That's all there is to it. And I welcome any sort of comments that you might have if you're using the system, if it's working for you, or if it's not working. If you want to share your trade with me, I'm trying to get my trade going so that people can see what I'm doing and then they can share their trades. But I don't know, this new release of Thinkorswim came out over this weekend, and it's kind of a big release, and I had some bugs with it. But with the Java virtual machine part of it, but I was able to resolve that, and I can't get my trade to work, but I will eventually. All right, so on the next video, and I have to have an actual order or an actual position in order to do this one, so I'll have to wait until that happens. But on the next video, I'm going to show you on the Thinkorswim platform how to, if you have a 75%, 50% gain loss set on your position, I'll show you how to put an order in for that on the Thinkorswim platform. And it works pretty much the same way on all the other platforms as well. So that's it for right now. Thanks a lot for watching. Have a great day and happy trading.